The market is making a trillion-dollar mistake with this healthcare titan. Here's why I'm betting against the crowd. Let's cut through the noise. UnitedHealth Group, NYSE, UNH, isn't just struggling, it's being priced like a failing company. But here's what the panic sellers are overlooking. This healthcare behemoth now trades at valuations last seen during economic crises, despite processing enough medical payments annually to equal the GDP of Canada. I'm doubling down while Wall Street sleeps on 3 critical advantages you can't replicate elsewhere. Full disclosure, as of August 13, 2025, UNH stock has cratered 47.6% year-to-date. The reasons? Soaring medical costs outpacing premiums, a looming $1.6 billion legal settlement, and regulatory heat on its Optum division. These aren't paper cuts. They're serious challenges. But here's where it gets controversial. The market is treating these temporary storms as permanent hurricanes. Let's break down the contrarian math that's got me excited. At $270 per share, UNH trades at just 11.5 times projected 2027 earnings, cheaper than Walmart and closer to steel mills than healthcare innovators. Compare this to its 52-week high of $630, and you're looking at a 57% discount. While competitors like Cigna sport slightly lower multiples, none match UnitedHealth's triple threat. 50 million insured lives, a pharmacy benefits manager filling 1.5 billion scripts yearly, and a healthcare services arm, Optum, that alone generates $260 billion, more than entire Fortune 500 companies. But here's the kicker, most investors miss. This isn't speculation. Analysts still project $40 EPS by 2030, requiring just 6% annual growth from a company that's delivered 13% yearly earnings growth for a decade. Apply a conservative 16 times multiple, half of the S&P 500 average to those future earnings, and you get a $640 price target, 135% upside from today's fire sale prices. Meanwhile, you're pocketing a 3.38% dividend that's grown for 15 straight years, backed by $30 billion in annual cash flow, enough to cover the payout 7 times over. Why the doomsday scenario won't last? The Medicare cost surge sparking investor nightmares? Management already locked in 2026 premium increases to match. The $1.6 billion legal overhang? That's 0.1% of their annual revenue. Painful, but not existential. And Optum's regulatory scrutiny? Remember when Amazon faced antitrust fears? Dominant market positions often draw scrutiny before becoming accepted infrastructure. Here's the controversial truth. In a market where profitless AI startups command billion-dollar valuations, UnitedHealth's cash machine trades at Depression-era multiples. Yes, healthcare costs are complex. Yes, political risks exist. But does that justify pricing the industry leader like it's going out of business? Consider this. Even if UNH's growth halves permanently, today's price would still be a steal. The bottom line. This isn't a get-rich-quick play. Medical costs could stay elevated. New regulations might emerge. But at these levels, you're essentially getting Optum's $260 billion revenue stream for free. The insurance business alone justifies the current market cap. While others fixate on short-term noise, I'm banking on the irreversible trends of aging populations and healthcare digitization, where UnitedHealth holds all the cards. Now I want to hear from you. Is the market right to punish UnitedHealth this severely, or is this the buying opportunity of the decade? Could regulators truly dismantle its vertical integration advantage? Drop your take in the comments. Let's debate the most misunderstood stock in healthcare. Disclosure. The author holds positions in UnitedHealth Group and NVIDIA. The Motley Fool recommends both companies and maintains strict editorial independence. All figures current as of August 2025. Sources: company filings, Fool.com analysis.